present value is a tool to adjust future payments for the effects of inflation, inflation being the overall increase in prices over time, and the fact that a dollar received 5 years from now is not worth the same as a dollar received today. And we have an interest rate assumption, an inflation rate assumption, that could be called the interest rate, the hurdle rate, or the desired rate of return, all meaning the same thing for this simple example. So to start, real simple, let's say you invest a dollar for 1 year at 12%. A year from now, you're going to have a dollar plus 12 cents, or 1.12, $1.12. And I use that to set up the next example, which is present value. So that was the future value is $1.12. What if in the second example, you need $500 a year from now, you're going to assume a 12% interest rate, what would you have to invest today? Well, you're going to take $500, the future amount you need, divided by 1.12, and that equals $446. You need to invest $446 today to have $500 a year from now, assuming a 12% rate. One more that's a little more complicated. What if you need $900 4 years from now, and you're going to use the same interest rate? Well, again, you're going to divide the amount you need by some number, but in this case, that number is bigger. Instead of 1.12, it's 1.41. Makes sense because as time goes on, the amount of money you need to invest gets smaller and smaller because it's growing and growing and growing over a period of more years. So if you need $900 4 years from now, it's $900 divided by 1.41, which is $638. So you invest $638 today. 4 years go by, you'll have $900, assuming a 12% interest rate. What this all gets to is a term called internal rate of return, where if you have cash outflows and cash inflows, the internal rate of return is the rate at which you would adjust all the payments so they equal zero. And companies look at internal rate of return when they consider whether or not to take on a project. And they'll have a minimum internal rate of return that they want to achieve. And if it's above if the internal rate of return is a positive number, they take on the project. If they adjust all the payments and it's a negative number, more cash outflows than inflows, they disregard the project. So internal rate of return is another metric that's used for net present value.